So you would test a bunch of different sort of lengths of trends in time and see whether, for example, a 10-day trend or a 15-day trend was predictive of what happened next?
Sure. You would, try all those things and see what worked best. But the trend following would have been great in the 60s, and it was sort of okay in the 70s. By the 80s, it wasn't such a
It didn't, because everyone could see
other
that.
people did it.
So what happened? So how did you stay ahead of the pack then?
Well, we stayed ahead of the pack by finding other approaches and shorter-term approaches to some extent. But the real thing was to gather a tremendous amount of data, and we had to get it by hand in the early days. We went down to the Federal Reserve and copied interest rate histories and stuff like that because it didn't exist on computers. We got a lot of data and very smart people, and that was the key. I didn't really know how to hire people to do fundamental trading. I had hired a few. Some made money, some didn't make money. I couldn't make a business out of that, but I did know how to hire scientists.
Efficient market theory would suggest that all known information is already priced into the market. But I want to know what you think. Let's begin. So we're finally going to look at a real edge in the market, or at least what I believe is a real edge in the market, by using machine learning to help us uncover where this gap is. Let's just recap very quickly. In the first video, we discovered that we need at least a 1% edge. In fact, if you have 1% against you, i.e. it's like walking into a casino, you're pretty much guaranteed to lose all your bankroll. Guaranteed. If you have 1% in your favor, excluding the broker fees, etc., so more like 2% in your favor, then you have an actual edge, and your chances of increasing your capital are equally very high. So having an edge is fundamental. That's what all of this has been about. Now, if we go over to the forecast tab here in this model, again, here is the price of the S&P 500. And I'm just going to mark this up very quickly. What we've been trying to do is to predict the close to close price. We've just been trying to predict the very next day. And if this is your first time seeing the series and you're not familiar with the previous videos, it makes no sense to watch this. You want to go back and check those out because you'll have a real advantage coming into this video. Some of this might not make sense to you otherwise. That said, we've been trying to predict the close to close. So if this day here closed up, we'd want to predict that, will tomorrow be up or not? Or if all of these days have this sequence of closing, so up, up, down, 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 up, down, etc., to the degree of magnitude they have, can we predict what will happen on this day? That is what we've been running through AI models or deep learning models. That is what we've been running through machine learning models, i.e. XGBOOST. And as you can tell from the previous video, we've had some very disappointing results. However, in the months of researching and working on these models and working on ideas, there are things that have come up where I've been pretty blown away and found what I believe to be a true edge. And that's what we're going to cover right now in this video. So let's not delay, let's get right into it. So here we are about to run the XGBOOST model. And I want to just baseline things first. So we're going to run the S&P 500, again, a very liquid ETF. We're going to run the SPY. And we're going to look at it from a close perspective. We're going to say, hey, will tomorrow's close be up or down? That's what we're going to try to predict here. Now, as you already know, we were quite unsuccessful with that in the previous video, but I just want to baseline us again to make sure that we're framing this correctly. So let's import the packages and let's import the data. So now we've pulled in 20 years of data and we're going to calculate the returns. If you haven't seen the first video, definitely watch that. It'll make it very clear why we're doing returns. And I want to look at, say, 10 steps in the past in terms of the magnitude of the returns, etc. So let's look at our data. Yep, we've got a lot of data points over here now. So here's my open, high, low, close volume, close in volume, close in volume, close in volume, close in volume, etc. For the previous days as well. So we're going to take this, feed it into the model and say predict tomorrow based on this sequence of data. And we're not putting in any indicators, etc., because as we saw, there are a lot of indicators which are not very useful at all. And a shout out to Jake here. Jake, by the way, I really appreciated your feedback on the last video, giving some suggestions as to what to test. That's exactly what we want Crypto Wizards to be, a way to share ideas, and I definitely will be looking into those. So let's select our data, confirm that's the data we want, and now let's push it through the model. So I'm going to put it through XGBOOST now, which is essentially what we've just done, and now we're going to see what those results look like. So let's give it some time just to work that out. So far I can tell you it's already not looking very good. So running this through what's called k-fold cross validations, so just chopping this up into 10 different ways from Sunday, I can confirm that we have a 53% accuracy, i.e. we were able to predict this with 53% accuracy, which really is zero edge. Now, a lot of you, again, you might be saying, well, that could be a 1% or 2% edge. First of all, it has a standard deviation of 1.96, meaning that it might actually just be 51%, or, best case, you're looking at 55%. So really take that with a grain of salt. But either way, that is 53%. It's not very good. And actually, interestingly enough, if we go and change the sequence or steps to, say, 1 day, and we rerun that again, let me just clear all of this and rerun it again for you to that point. So we'll just power through. And so now we've only just got it looking at yesterday's sequence. We're going to see how much of a difference that would have made. So this is just to baseline us to say, how accurate is this model? You're going to see it'll run much, much faster as well. So we get pretty much the same result. In other words, all of the previous 10 steps really had no impact. Zero. That sequence didn't really help us predict tomorrow at all. Now, you might be saying, well, there's still an edge. And just remember, looking at this, if you look at the SPY over 20 years, it went up. We've had more up days than down days. And the reason why I can say that with confidence is, I've triangulated that same 53% with the Tastyworks channel. They've got a data scientist on there who I've learned a lot from as well. I think he's a fantastic guy. And when I saw him talking on that video about the 53%, I was like, wow. Or on one of their videos about 53%, I was like, wow, that's exactly what I'm seeing, is this constant 53%. Meaning that we have zero edge here. It's just predicting what actually happened, and there's no guarantee of what will happen tomorrow. Now, let's actually look at the good stuff. So the first change I want to make, and I'm going to reset all of this. Instead of predicting the close, we're going to predict the high. So instead of telling the model, hey, I want you to predict whether tomorrow will be up or down from a close perspective, let's predict it from a high perspective. So let's run that now. And this is where it gets pretty exciting. So we're just going to plow through. Same thing. We got our open, high, low, close, volume, high, close, volume. Now going back 1 day. And we're just going to plow through this and put it through the model. So this is where it gets really interesting. And I'm going to start talking about what all these numbers mean in a minute. 66%. 66% with a 2% standard deviation. I find this fascinating, both fascinating and very, very interesting. And there's more to come. There's more to come. This is not the end of the video. There's some really good stuff to come in a minute. So with all of this information here, open, high, low, close, I can, with a 66% accuracy, predict whether the high tomorrow will be better or worse than the high today. Whether it will be up or down. I think that's magnificent. I don't know what you feel about that. And for the traders watching this, how would you trade that? And how would you trade it using options? That's where the challenge really comes in. How would you choose to use that information to profit from it? I'd like to hear your thoughts, so please let me know how you would plan on doing that. But we've got a lot of fields going into this over here. So we know the close. And so the close is going to give us a lot of certainty, because if the high was up here, but the close ended up all the way down here for that particular day, then yeah, it's pretty obvious that it's unlikely the high is going to go as high on the next time round. So I think that this is very useful, but I think we can make it more useful and less accurate, but more useful, if that makes sense. So what I'd like to do, and I'm going to talk through some of the numbers here as well, is I'd actually like to change this a bit. I'd like to take out all of those extra fields, the open, the high, the low, the close, and we're just going to have the high, and we're just going to have volume, and we're just going to have whether that was up or down. We're going to get rid of the sequences for the previous days, everything. So let's do that now. So now you can see we just have the high, the volume, excuse me, and the outcome. And so if I go and run that through our model right now and see what those results look like, what's very, very interesting is we still have a 58% accuracy with a 2% standard deviation. So call it 56%, meaning that we have a 3% edge, meaning that if I don't know, because 53% was our baseline, so we needed something above 53%, just remember that. So I don't know about you, but I find this really kind of interesting. I don't have to know the open, I don't have to know the low, and I don't have to know the close. I just need to know where the high was for that day, which arguably, if you haven't closed out yet, how could you tell? Again, there's always a catch. There's always a catch somewhere. But as long as I know the high, I have a 3% edge on being able to predict whether our high tomorrow will be better or worse than today. Now, if we look at some interesting numbers, the accuracy of this is for both predicting down and up. So if we break up that accuracy between the zeros and the ones, one meaning it will be up, zero meaning it will be down or the same, we have the same kind of accuracy for predicting both of those, which is kind of interesting, but there's more detail to go into here in terms of the classification report, so that any data scientists watching this will put in some really useful comments about how accurate this is in the comments. So that to me is very, very interesting. But now let's try and do something else. Let's take our close price again and try and predict that. Let's keep our sequences at 1. Let's get rid of that change we made earlier. And instead of trying to predict whether tomorrow will be up or down, let's just predict whether the return will be better or worse than the return was today. Let me explain. So if we go over here to this SPY chart, and I look at, say, this day to this day. So this day our close was over here, and the following day the close was up here. So the return was up a fair amount compared close to close. For example, if I looked at this day to this day, there's the close, the return was this amount. So let's tell it, for example, if I'm looking at today, here was my close to close. Will it be better or worse than what that close to close return is? I.e., if I take this percentage and apply it on this day, and so I'm going to get rid of those now. If I take the percentage gain from here to here and apply it to this day, that would be about this level. Will it be better or worse than this level, this price barrier over here? For example, let's pick another day just to make it clear what we're doing, because it took me a while to get my head around this. So if I look at, for example, this day, here's the close there, and here's the close here. The close to close is this. So if I apply that same magnitude, say, to here, will it be up from that level, down from that level? If I look at the close here to the open here, it's a small adjustment. What would it have been the next day? And that's what we're going to try and predict. What is the return? Is it going to be better or worse? So let's can all of those drawings now and go over here, and we're going to make a small tweak. We're going to just say, take this, and rather than it being greater than 1, i.e. up, is it going to be greater than it was today in terms of today's return? And we're going to do the same thing here. Okay, so let's run this. So hopefully I've not messed anything up, which typically happens a lot of the time. And let's go through this now. So we're going to pull our data, we're going to calculate our returns, and we're going to put in the predictive features that seems to have been accepted well. And here you can see the outcome, 00101. So for example, if I look at my close here, the return today was 1.006. Tomorrow it was 1.004, meaning it went down, so it's 0. Here it was 1.004, then it went down to 0.97, so it was 0. Here it was 0.97, here it went up to 1.01, and here you can see it was 1. So this is the outcome that the model is going to work to predict. So we're going to just set that in place. We're going to bring in previous days. Why not? Even though I feel like that really doesn't make much of an impact at all. And here we go. We're going to run it through our model and we're going to see what the accuracy looks like. And this is the cool thing, by the way. Once you built a model, you can tweak things and play with it. 75% accuracy. In fact, I reckon if we take out the extra fields over here, so if we just put in the prediction and the volume again and run that through the model again, let's have a look at what that accuracy comes out like. So roughly the same, 75% accuracy, which is quite incredible. I know when I put CCI to this as well, I got something like 77%, or there were some parameters I put in. I was able to actually improve this slightly, but look at the point here. The point is that I can predict with 75% accuracy whether the return tomorrow is going to be better or worse than the return was changed today. It's predicting zeros with a higher accuracy than it is predicting ones, but on the whole, they're virtually the same. Now, here comes the question. When I first saw this, I was thinking, wow, this is amazing. You know, this is a golden goose right here. And then it comes down to, oh, how would you trade that? Well, if I look again at the S&P here, and let's just take a look. So let's say, I'm actually going to draw a candle. Let's say I've got a good guy here, and I've got a bad guy here. So the pink one or the purple, whatever, this is a down day, and this one here is an up day. So now if we look at our close to close, so here was my close on my up day, and here was my close on my down day, I had a swing of about this much. So what the model is going to say is, okay, well, if I take this close and really predict the same swing, so about that much, and we calculate this exactly, but just for illustration purposes, here is where the close, I want to know if it's going to be up or down from this point. Is tomorrow going to be better or worse? So with 77% accuracy, it's going to tell me, yep, it's going to be up or down from here, which is quite phenomenal. But, and there's a big but to this, bear in mind that when you look at the options pricing model, in fact, let's get rid of this now. If you look at the options pricing model, so I'm going to go over here to the normal distribution curve. We already know with a certain probability where prices are going to be. I'm going to bring up an options chain very quickly so that you can actually have a look at this. But we already know with a percentage accuracy based on options pricing where a price should be, and that's built into the price. So let's switch there now. So we're on one of the broker platforms that I have access to. So typically I look at this for looking at probabilities, and then for actual trading, I would use Interactive Brokers, which I've got down here. And a lot of that is because of what country I live in, etc., and how easy it is to transfer money to what broker, etc. But I really like the Tastyworks platform. So I already included one of their videos. By the way, they have no idea that I'm talking about them on this channel. This is not me sponsoring them. I just think their software is really good. The same guy who developed this business essentially did Think or Swim and sold that to TD Ameritrade. So these guys really know what they're doing. And on their platform, I want you to have a look at this. Right now, we're on an options chain. If you don't know what that is right now, don't worry so much about it. Just know that here are certain strike prices. So right now I'm looking at the SPY. The last price is 314, which is around here. But essentially this tells me what the option would be priced at depending on the strike price I'm going for. So for example, if we're at 314 and I want to look down here at 318, that would be an increase in the price because we're at 314 today. And when I look at this in the money percentage calculation, it says there's only a 1% chance that between now and July the 8th, which when I look at the date, that's today. So between now and the close of today, that it will reach 318. It's very unlikely by the magnitude that the S&P moves that we will hit that. And so the option price for this price is extraordinarily cheap. Now let's pick a different date. So let's say it's July 9th and I'm looking at July 10th. So we're looking at the next day here. And I look at 318. You can see there's actually a 23% chance of the price being at or above 318 by July the 10th. So I already know the percentage chance before I even place a trade. You can see why I love options and I love talking about options so much. But based on the normal distribution, so we spoke about, normal distribution, based on this normal distribution curve, which we know is priced into the Black-Scholes model and it's built into options pricing models. This assumption actually allows us to calculate what the percentage in the money should be, i.e. what is the percentage likelihood. So the question is, going back to our machine learning model, if I can predict this with 77 or 75% accuracy plus or minus 1 standard deviation, then do I have an edge in the market? And my answer to this is yes, because here's what I believe the machine learning model is doing. And I'd really like to be challenged on this because, I could be wrong. 100% I could be wrong. So I really am open to challenges on this. Here's my belief. We know that the market moves on these random distributions. However, when we look closely at the profile, the returns profile of the S&P, which is what we're looking at here right now, as we said in the first video, we can see, number one, that the returns are more heavily weighted on the downside, i.e. when the returns are larger on the negative, that happens more often than when they're larger on the positive, number one. Number two, a normal distribution curve might look something like this. Or actually, let me draw that again. It might look something like this. Meaning that there are gaps. There are gaps here in terms of how the options pricing is calculating those returns and how it's actually taking place with the machine learning model knowing exactly the profile that it really fits, because it's calculating with that 77% accuracy based on its true behavior, not its perceived behavior. And that right there is where I think the arbitrage could be. I would look at this in such a way to say that, is my percentage probability for where this price will be based on the machine learning model? So if I go over here and I look at, did the model predict 51% accuracy? If so, by the way, it was right 76% of the time. If it predicted 58% accuracy, which the machine learning model tells us, it tells us the probability that it's predicting, it was right 81% of the time. So my question is, does this 81 or 83% beat what the options pricing model is pricing that move in at? If it does, there's your arbitrage and there is your edge, because over time you have at least a 1% edge. In other words, if I was to place options trades every day, so gun to the head, or 3 times a week based on when I can trade SPY, because you have expiries you can trade often. If I was to trade this 3 times a week, gun to the head, I would want to use the machine learning model to help me determine my bias. Because if I'm right more times than I'm wrong, I'm going to be in profit. The other side of trading this with options is you want to be very clear about the price you're getting. So for example, let's say I decide to sell an option to someone. And again, if you don't understand how this works, don't worry, because I'm just going to show you the end result anyway. Let's say I decide, based on what the machine learning model is predicting, I should be at based on the return. So I know if I apply today's return onto tomorrow, where that price barrier is. I already know that. And I also know the percentage likelihood it should be up or down. So if I go and look at, say, taking some kind of vertical spread, and I say sell a call here and buy the next out of the money call here. So I'm protecting my loss by doing that. This is what that actually ends up looking like. So let's just go over here to the payoff curve. My maximum profit is $38. My maximum loss is $62. But that said, when I go back to the table, I have, and I'm just going to change this to be percentage out of the money. So let's just change this here. I have a 63% chance of this working in my favor. So the probability is already known. I already have a 63% chance of this working in my favor. In fact, the exact probability of profit, which is what this down here shows you, this probability of profit here is 61%. So I already know that figure. So what I need to make sure of is that if I take the spread, i.e. $1, and I multiply it by, let's go back to percentage in the money, and I multiply it by 37%, I need to at least be getting that price in. So 1, which is the difference in the spread. If this was 5, I would take 5. Multiplied by that 37% is the credit I want to be taking. So because I'm a net seller of an option here, by the way, I'm taking in this $38 immediately. I lose it if the price doesn't go where I wanted it to. But I take this in today. So you'll see here, this is a net credit I would take. And it's better than the probability over here. So this is actually a good price for that option. I'm looking at this and going, okay, there's a 37% chance this will go against me. But what is the machine learning model predicting? And whatever that's predicting, I'm going to go with that machine learning model. So either I'm going to go on the call side or the put side, and I'm going to find the best possible trade from a pricing point of view. But my direction, I'm going to bias towards what the machine learning model says. And that is where I believe the edge is. Now, it's very difficult for me to back test that because to actually acquire the data for what options prices were going back costs quite a fair amount of money. However, that is something that I'd like to do. I'd also like to know what is your opinion? Do you believe that machine learning can identify the behavior of a stock better than what the general options price can do it at? Do you believe that's possible, or do you believe that would have already been factored into the options price? Therefore, that is not an edge. I'd be very keen to know your feedback. My honest opinion is it does. And even if there's a 1% edge I can gain from that, it's worth it. And it's worth it because if we go back to our probabilities here, we know that it's night and day. The difference between having 1% against me and having 1% in my favor is night and day. So just to be very clear, how does a vertical spread like that, a credit spread that's called, and you also have debit spreads, but how does a credit spread like that make money? Well, if I place that debit spread for this price barrier here, and let's say I'm betting that something's going to go up, essentially I make money, doesn't matter where it goes. I take that fixed income, I take this sliver of income here. And I just keep doing that, and those little bits of income add up. It's a very cool strategy, in my opinion. It's my favorite option strategy, which I'm pulling into all my assessment for how to trade these things. Because it only requires 2 options, meaning there's less cost involved, trading through bids and asks, etc. And it's very easy to gain probability in your favor in terms of you essentially make money whether things go up or sideways, or down or sideways. So you already know your probability. As long as your actual probability is higher than what the option price is at, then that's great. So let's say this day I took a little sliver of income here, and this day I took a little sliver of income here, and this day it was down here for whatever reason, or etc. These, or it would actually have been higher due to the close to close. But the point is that each day you're taking wins and losses in small amounts, but the amounts that you're winning in, taking your profit multiplied by your probability of profit with your 1% edge, the amounts that you're taking in bring you to this scenario. What do you think of that? I've been so excited to take you through this that I feel like I might have even forgot things. I will be in the next video talking about market sentiment and how I do believe there is a survey that provides an edge, but I think that deserves a whole video to itself, number 1, and number 2, there's quite a lot to wrap your head around in this video. Let me know your thoughts. Take care. Talk soon.
What role did machine learning play in all this?
Well, in a certain sense, what we did was machine learning. You look at a lot of data and you try to simulate different predictive schemes until you get better and better at it. It doesn't necessarily feed back on itself the way we did things, but it worked. And
so these different predictive schemes can be really quite wild, quite unexpected. I mean, you look at everything, right? You look at weather, length of dresses, political opinion.
Length of dresses we didn't try, but...
what sort of things?
Well, everything. I mean, everything is grist for the mill, except hem lengths, I have to say. Weather, annual reports, monthly, quarterly reports, the historic data itself, volumes, you name it, whatever there is. We take in terabytes of data a day. and store it away and massage it and get it ready for analysis. And you're looking for anomalies. You're looking for, like you said, the efficient market hypothesis.
But
right.
any one anomaly might be just a random thing. So is the secret here to just look at multiple strange anomalies and see when they align?
Well, any one anomaly might be a random thing. However, if you have enough data, you can tell that it's not.